Hi, this is Nomad UR, week 26, 2022. The world is on the verge of a recession is the name of this video. Here we look into current state of the economy and recession probability. First, I want to start this video with the latest news from the World Bank. The World Bank cuts its global growth forecast for this year because of the war in Ukraine, surging energy and food prices, and rising interest rate. We will overview those facts in this video. Then, World Bank added, for many countries, recession will be hard to avoid. This is our starting point. Let's go to the next slide. In this slide, we have a list of economic conditions that we have at the moment. Economic slowdown because of late business cycle state, high inflation and interest rates, high energy assets prices, yield curve worse, increased risk of bankruptcy, extreme low customer sentiment, crisis in European Union and Russia-Ukraine war. First, let's start with economic slowdown. In this slide, you can see a current business cycle estimation from Fidelity from end of the May. It indicates the beginning of the late cycle for US and Canada, and for European Union, United Kingdom, it's already in the middle or closer to the middle. There are other evidence of the late cycle, and you can also watch another my video about why we are in the late cycle. So it is a fact by now. Last time we were in the late cycle in late 2019 before COVID-19 recession. Next slide is a quick overview of business cycles. Basically, business cycle is a fluctuation in economy expansion and contraction over a short period of time. But in long run, economy grows. In this slide, you can see main phases of the business cycle. Also, as you see, usually it lasts around 10 years, but it may be longer, it may be shorter. And the expansion phase is usually the longest phase of the business cycle. Here you also can see some recommendation for assets allocation for different phases of the business cycle and usual annual return in this phase. I recommend you check links in the video description for more information about business cycle and assets allocation. Now let's go to the next slide. In this slide, you can see inflation chart, the US inflation chart, and you can see that from 80s we have relatively low inflation. Now we're back to inflation crisis of 70s. In chart, I have added the lines for all major US recession. As you see, most of them happens at high inflation, like here, like here, like here, also here and here and here and here. Only COVID crash of 2020 happens because of pandemic and lockdowns. So probably it was unusual case, not fully related to the inflation. Yes, inflation was high, but not as high as for the other cases. Let's go to the next slide. This is a rates chart for last 70 years. Usually government is controlling the economic cycles of expansion and contraction by rising rates when economy in expansion, like here, and lower rates if economy in contraction phase. So in recession phase, contraction and recession, it's synonymous. So here we have a recession, and you see the contractions, the decrease of the rates. Here we have a recession, and you also see decreasing or lowering the rates up to the zero, and we have like almost zero rates, almost 5 years, even more like 7 years. This boosts economy in slowdown and tame the bubble growing in expansion phases. Now situation is different. Government now need to choose what to do to tame inflation and get a recession, or stimulate the economy that leads to the inflation growth. Because high inflation is bad, low inflation or even deflation is bad too. So it is important to keep it in low, but not too low. So this is the Fed's hard choice. If they want to fight inflation, they should increase rates that leads to recession. If they want to not get a recession, they should decrease rates, but this leads to the inflation. Now let's talk about commodity prices. Commodity. This is oil price chart. Commodity prices, especially energy sector, is extremely high now. You see it at this oil price chart. And if we check history, recessions usually happens after high commodity prices, oil especially. Look, for example, at the recession of 2008. This is clear a recession that happens also because of the high oil price. Not only because of that, but it was one of the reasons. You can also see that in 2000, recession in 2001, also there was also a high commodity price, and also in early 90s, when you have like a war in Iraq, like Iraq invades into the Kuwait, I think. And also you have the same kind of condition in early 80s. Why it happens? Because high prices for the commodity means lower margin for production that leads to lower income for companies and result. Also, when inflation is high, investor relocates their assets to more stable assets like commodities, like gold, for example. Remember, commodities always grows on the high inflation environment. I was talking about it in my video called Inflation Protected Assets. You can watch it here. Let's go to the next slide. The next slide is about yield curve inverse. Yield curve inverse is one of the great leading recession indicator. So we see that we already have inverse in the beginning of this year here. And now we probably get it again here. All of this indicates an upcoming recession in next 6-12 months. This is really popular leading indicator. Usually a recession happens like 6-12 months in 90% of cases. This happens here in a recession of 2008, also here in the recession of 2001, and also back to the past. You can check, you can basically Google it, and there are a lot of charts about yield curve inverse. I also talked about it in my last video a month ago about it. So now let's go to the next slide. Increasing risk of bankruptcy. In this slide, you can see a chart that shows the bankruptcy risk, the blue one, in compared to the S&P 500 prices, and 3 recession that we have before in these blue rectangles. It's clear that dot-com bubble recession and 2008 crisis was clearly after rising of bankruptcy probability here and here. Other problem is that currently we have a lot of zombie companies. At the next slide, you can see a chart of numbers of zombies in the Russell 3000. It's basically kind of the same of S&P. Zombie companies is basically an unproductive firms that cannot pay their debt interest. You can read more. In this slide, I want to show you current customer sentiment in compare to S&P 500 chart. This chart is show you how well people in US feels about the future. As you see, it is extremely low currently. And usually this chart shows you the greed and fear of the investors and people in general. When it's low, this means that this is a good buy opportunity. When it's high, it's better to book profits. This chart is one of the reasons why I think we are not get a recession this year, because crowd is wrong most of the time. I talked in previous my video that I am expecting a pullback, even to all-time high in S&P. Also, you can see that last recessions starts when this indicator was at the maximum, like here, for example, or here. And usually recessions or large corrections in S&P stops or near the point where it stops when this indicator was at the lowest point. For example, here, or here, or here. Okay, now let's go to the next slide. At this slide, we will talk about European Union future crisis. If you look into the chart from Fidelity that I was showing at the start of this presentation, you will see that European Union is much closer to recession than US. China is in crisis too. So when you have two largest economies in recession, this might trigger a recession in US. This winter would be really tough for European Union because Russia will probably turn off the gas and oil supply. This will lead to up to 50% drop in industry of the European Union. Also, this makes an oil price or commodity price higher, and this is a large factor for recession, as we know from previous slides. War will not over in close future, so a lot of countries will increase their military budgets. Of course, this can stimulate economy for US, like it was in World War II, but probably this not helps a lot. So we also have escalation risks and food shortage problems. Growth of food prices, why it's so important, means for people they need to spend more money for food instead of other parts of economy, especially discretionary or cyclical sectors. This is non-mandatory products. So as a conclusion, we can say that all of this probably lead to recession in European Union and drown other countries into global recession. This is what World Bank means by Ukraine war risks. So, quick conclusions. All data indicates that we have all signals about upcoming recession. Usually most of recessions happens at the start of the next year and after Congress elections. So I think next recession will not start this year, but probably at the beginning of the next year or at the middle. How to benefit from this and protect your finance? I will talk in the upcoming videos. Subscribe to get updates. Have a great week.